Recession fears prompting a dramatic change in the outlook for the Fed, but is that on target? Senior economics reporter Steve Leisman joins us now with a look at the reset for Fed expectations. The market's done a lot of work for the Fed, Steve.
Yeah, and then it's gone the other way, though, Melissa. This is what's interesting because more than 80 basis points of Fed tightening has come out of the market in just the past couple of weeks as markets think a recession is on the way, and the Fed is going to respond later next year by cutting rates, and cutting rates pretty sharply. Take a look. Just 3 weeks ago, the futures market priced the peak funds rate at 408, and that was in the contract for July 2023. Weaker economic data came along, gathering recession clouds. They've now prompted a repricing to a peak funds rate of 327. Is that right? 326 for February of 2023. Another 170 basis points. Take a look at the curve now. Or 1.7 percentage points of tightening is expected over the next 8 months, including a 75 basis point hike later this month, 50 in September, and 225s coming along. Once that hit the peak rate of 326, it's then priced to start cutting and bring rates back down to 270 by the year end 2023. Alex Manzera from RJ O'Brien writes, the Fed appears to be successfully squeezing out inflationary expectations by replacing them with expectations of a hard recession. Not everyone, however, is on board with this outlook, with this new, more dovish Fed coming. Wells Fargo writing, quote, the market is pricing too much easing by the Fed in 2023. We are skeptical the Fed would do an abrupt U-turn into easing mode. Wells thinks the peak funds rate has to hit 4% before the Fed is all done. What could make this pricing correct? A sustained decline in inflation. Fixed income markets look to be picking up on some sense that inflation is waning from the lower commodity prices you've seen there and the strength of the dollar. We'll get more detail on the Fed outlook today in the minutes of the June meeting. And Melissa, just real quick, it's hard for me to see a recession if you have a resurgent or a strong service sector and strong jobs numbers coming Friday. But we'll see about those.
I mean, the dynamic, Steve, though, of the strong dollar and waning inflation, let's say inflation has rolled over and we see the strength in the dollar. The strength in the dollar is really at this point being driven by the weakness in the euro, and there's not much that can be done about that. I don't know how much power the ECB has.
No, you kind of want that situation in terms of helping your, but you want that, Melissa, I think, in terms of helping your inflation fight, right? Sure, it may be something that hurts U.S. exporters, but that whole process, that whole dynamic is something that helps bring down domestic inflation. And you're right, it's because of the weakness of the euro, but we'll take it any way we can get it. The outlook for European tightening is 140 basis points, while the Fed, having already added about 160, is seen adding another 170. So it's that differential between how much more the Fed is going to do compared to the ECB that seems certainly to be driving this weakness in the euro. And make sure that you and Joe have your parity party hats available for when it happens.
They're ready.
If it does happen.
It could be any day
now. And your parity party hats ready. Yeah.
Shepard Smith here. Thanks for watching CNBC on YouTube.